Alright, hello everyone. In this video, I quickly want to go over Thinkorswim because in my last video, there was a technical fault on my end where I wasn't able to display the screen. So I'm gonna re-record this part. So jumping right into things right away, the most important thing here, I know there's a lot, but the first thing you need to focus on is this thing called the option chain right here. You press down this click down menu, and basically this displays all the calls and puts that you are able to trade. And on the left side are the calls which you can trade, and on the right side are the puts that you can trade. And if you want to sell a call, it's under the bid price. And if you want to buy a call, it's under the ask price. Same thing on the put side. If you want to sell a bit, short a put, uh, it's under the bid. And if you want to buy a put, it's under the ask. All right. So right now we're under the stock or our underlying security is NVIDIA, right? And actually, I'm gonna use this sheet that we got in class. Right, there we go. I'm gonna just basically go through the first four problems. The first one, buy one contract on Apple expiring on February 13th with a strike price just north of Apple's current stock price. So go here, search APPL, actually AAPL right there. So today Apple closed at $273.68. So if we want to buy a call just north of this price, strike price 275 right here. Buy, right? We buy one contract, single spread, buy side, expiration. Hold up. We'll go to specified for February 13th right here. Buy. All right. And if you want to fulfill this order, press confirm and send. It'll pop up a bunch of additional information. So for your uh, call to break even, you would need Apple's stock price to go to 275 and 98 cents. Max profit, infinite for a call, max loss. This is the premium or the cost you'll have to pay. And just press send, and it went through here. All right. Next, we have uh write one contract on a call on Apple expiring on February 13th with a strike price just north of Apple's current stock price. So, um, personally, I don't think Apple's price will drop. So I'm gonna go to a stock that I'm bearish about, Palantir is my choice. February 13th for the bid. Their stock price closed at 139. Just north, it's 140, 141. We'll go 141. Sell, call, and then press confirm and send. So this is the break even price I would need. for this for my trade to make zero profit. My max profit would be this number over here, which is the premiums I would receive from the buy side. And for a short call, my losses are infinite. Um, so let me look at this quickly. So I just want one contract. Send. Or I guess that was illegal. All right, so I don't know why it keeps on saying that that selling the calls uh keeps on saying that trade is illegal. So we'll just move on to the next problem. So problem three on this sheet, buy one contract on a put on Apple expiring on February 13th with a strike price just north of Apple's current stock price. Oh, all right, go down to February 13th. Sell just north of current stock price, right there. Sell. Kind of hesitating because I don't want to make the same trade or an inverse trade on the same stock. So it's just a simulation, so it won't really matter in the end. All right, basically just simply as is, break even stock prices 272.4. It's our max profit 260. Max loss 27,000. Yeah, that's a pretty bad trade. Um, this reward to risk ratio is quite awful. So, um, I'll look for a different. Just go with Palantir again. Maybe not Palantir. Another stock. Let me just think quickly what I think will go down. Oh, Google. I love Google as a stock. However, at 318, I believe that's way overpriced. I believe that Google's uh, fair value is priced at 300. It probably won't move that much down to 300 in the next weeks. So I'll extend the put by 2 weeks. Sell. Buy. We're buying a contract on a put. Go down to one. Press confirm and send. Break even 1325. Max profit 31,000. Max loss 675. I like that way more. Send. All right. Last problem. Uh, I just want to be clear on this. Maybe this is getting a bit repetitive. However, this is the last trade we're gonna do. We're gonna write one contract on a put on Apple expiring on February 13th with strike price just north of Apple's current stock price. So not gonna do Apple again. Do a uh different company I'm bullish on. Uh Company I believe the stock price will increase on, will increase in the future. Let me think. Say Caterpillar. Uh Capital or asset focused companies are doing really well under this current administration and economy, and I see no reason why that would be any differently in a couple of weeks. So we'll do February 20th. Um, Write a contract just north, sell plus sell one, confirm send. Or actually, this is a pretty bad trade. The reward to risk ratio is not that uh appealing to me. Maybe over change the strike price to 174. See. All right. I think they're all like that. I think just writing puts is extremely risky in this way because I mean you're guaranteed a premium. However, your max losses can really screw you. Go plus, firm and send. So max loss. I mean, I'm not going to take this trade because I only have $67,000 in liquidity. I'm not going to potentially lose more than what's in my account. However, I just wanted to show you guys this is how would you write a put on an underlying security. Delete that. So I hope this video helped those who needed a little introduction to Thinkorswim. I know it's a lot to look at, a lot of information to process, and my professor uh, said that this interface will be on the exam. So I'd basically just get familiar with the bid ask mechanic, uh, know the option chain, recognize that calls are on the left side and puts are on the right side. And that's really all you need to know for for this exam, which is a good starting point. I'm sure there's much more you could do with this simulation software, and I'm excited to dig deeper into this. Thanks for watching.